Well, g'day there, traders and friends, market participants and enthusiasts right around the world. You are here with James on behalf of Pivot Point Trading as I sit down and bring you this technical snapshot of the US financial markets dated Saturday, April 8th, 2016. What I'm going to do, maybe over the next 20 minutes or so, we'll see how we go time-wise, is recap some of the advancements in the technical picture which we have seen since that last update which I produced. That was bordering on maybe 3 to 4 weeks ago. I wasn't entirely sure whether the Dow Jones Industrial Average, for instance, would hold at 17,200 or if it had the vitality, the strength, and the momentum to push it on all the way back up into this declining primary bearish trend line. Obviously, the later has been the case. Now, this is a strategic upload because we're starting to see, or really the maturity of, early reversal signals in terms of candlesticks over the past 3 weeks. This past week of trading, we started to see the sellers show back up at this declining resistance level. And it's very important and very timely that I speak about this in terms of technical analysis. I'm also going to address this. I mean, it really doesn't matter which market I start with. I can start with the NASDAQ. I can begin with the Dow or the S&P 500. I'm also going to speak about some of the major divergences setting up on the Dow Jones Transportational Average and also the Russell 2000, just to sort of recap some of the breadth or the weakness in breadth, which we're seeing to continue in many ways deteriorate as this market has pushed on back on up, not even into new higher lows or higher highs, but also still establishing, again, lower highs, macro lower highs. And you need to be aware of this because it is very, very important in terms of where this market is going further into 2016. So without further ado, I mean, first of all, I should say settle in, get comfortable. Perhaps make yourself a cup of tea, a cup of coffee, because we are going to get into the nitty-gritty of, again, the US financials, the markets themselves, and again, present you with a pretty compelling argument and an update as to why you should be very cautious if you are looking at this market in bullish terms and expecting this market to break out into new all-time highs for the year 2016. It is a very low probability and also a very low possibility, given again the deterioration which we are seeing fundamentally and also technically. What I'll do for you, let me just begin with, for instance, the S&P 500. It doesn't matter which one I choose, but let's just go back and recap some of the candlesticks which have been setting up over the past 2 to 3 weeks. I mean, I can go back further and really start referencing some of these high wave spinning tops or high wave dojis, whatever you want to call them. But you can just see for yourselves, just have a look at how many dojis and spinning tops we're seeing. We've got one here. We have another hammer candlestick right here. We pushed on up. We had 2 spinning tops just here. A 1 black crow reversal candlestick. We have another, hammer candlestick. Another doji. We pushed on up. We followed that with a shooting star. This is where it gets very interesting. We have a shooting star followed by a spinning top, followed by a bullish engulfing, which didn't continue higher. Very interesting to note. We have an inside day spinning top, a bearish Morobozu, almost a long day. This is a 3-day reversal candlestick pattern right here called an evening star reversal. We have another 1 white soldier continuation pattern right here. Did we see any follow through into Thursday's trading session? No, we didn't. Instead, we got a 1 black crow, the polar opposite, a very bearish candlestick. And then again on Friday, we've got a hybrid between what we call a shooting star and a gravestone doji, both showing, again, weakness in sentiment, the change of sentiment, and sellers showing up and around this 2060 to 2070 area on the S&P 500. This is interesting to note. If I zoom out and show you this on the S&P 500, you have to be realistic with yourself and you have to start asking yourself the serious questions. Is the S&P 500 making a series of higher highs, or is it still, and I repeat, is it still making a series of lower highs? Now, I can make this really obvious by taking off the annotations off my screen, but you can see since May 2015, we have a high, we have a lower high. Again, we got the waterfall sell-off in August, which established the first macro lower low. We had a somewhat short double bottom. We had a rally back up, and this is where, again, it gets interesting. Be realistic. Ask yourself the question. Did the S&P 500 rally up and make a new higher high? No, it didn't. We have a lower high, we have another lower high, and then we have 2 lower relative highs. What happened after that? The bulls gave up, the bears took control, we broke below structural support, we came back down, and on the S&P 500, again, we put in another lower low. Not only a minor lower low, but a macro lower low. We had another short-term double bottom, even though I'm not going to stretch the analysis that far and believe it is a short-term double bottom because it's not showing up at the right location, and this trend is nowhere near resolving itself to the downside or finishing the bearish move, which I am expecting, we've seen the slope of hope rally once again, which is what we saw throughout September and October 2015. And once again, ask yourself the question on the S&P 500, has this market rallied up and established another higher high, or has it resulted so far in another consecutive lower high? And the answer to that question, whether or not you want to admit it or not, is that it is still a lower high. Now, the November, and the December highs have not been taken out on the S&P 500. Let me bring back on my annotations. Now, I've addressed the daily candlesticks. What we expect and what we have been expecting on the S&P, the Dow, and ultimately the NASDAQ, if in fact it had, again, the momentum and the stamina, the vitality to get back up into the primary declining bearish trend line, is to ultimately fail. It doesn't matter whether it fails at 2,000 or whether it gets all the way up to 2,100. I am not expecting this market to break on out into new all-time highs for the year 2016. I'll go on the record and say that. I have been on the record for quite some time, and every video I make obviously is public through this YouTube channel. But taking a look again at those candlestick signals, they are showing up at the right location. We're seeing a plethora of shooting star candlesticks, gravestone candlesticks, 3-day reversal candlesticks in the form of evening star reversals, and consecutive one black crow candlesticks. This is where it gets interesting. Let's take the analysis one step further. You can see again the downward sloping trend line here. Ask yourself the question, has the S&P 500 broken above the declining bearish trend line yet? The answer to that question is no. So you can assume during a bullish bounce or a correctional move back into the declining bearish trend line, what do you think this sentiment, right, of market participants who are uninformed in the market, wouldn't it be fair to assume that, look, they'll buy into the complacency and think that everything's okay at the absolute worst possible time? When the market stages a rally and we begin the year so bearishly, we move back into positive territory for the year 2016, albeit very briefly. We're trying to struggle and hold on to the year-to-date gains. I think the S&P 500 is up 3 points year-to-date. This is where the foolish money jumps into the market and starts buying it, thinking that everything is okay. Little do they know that on the weekly chart, we are starting to develop a tweezer top candle. This shows up at reversal pivots on markets. It derives its meaning, much like all candlestick patterns, at the right location. And this is the right location at resistance. We're starting again to see the formation of that tweezer top pattern. It doesn't mean that the bottom's going to fall out of the market and we're soon going to retest the lows, which we've established twice in 2016. But more or less, it shows us, or at least it's telling us, that market participants, informed market participants, are pulling the handbrake on this bullish move higher. Let me change this and go over to the Dow Jones Industrial Average. Let's just quickly go through and recap some of the candlesticks which we've seen. I mean, again, you can see the high wave spinning top if you want to go all the way back as far as early March 2016, but we've continued this again, parabolic rise to the upside. It's resulted in spinning tops. You can see hammer candlesticks followed by more spinning tops, failed bullish moves to the upside. We get somewhat confirmation, or not so much confirmation, but continuation to the upside, which is flakes. You get these shooting star candlesticks, spinning tops, engulfing candlesticks, much like on the S&P 500, which just simply go nowhere, followed by inside day candles, 3-day consecutive candlestick patterns, which are showing us evening star reversals. You get these flaky bullish day moves, which everyone gets excited about. Again, market noise is saying, look, everything's going to be okay. But then the following days, we're just seeing, again, one black crow candlesticks, which again are the second strongest reversal candlesticks in the world of Japanese charting, or in the world of Japanese candlesticks. Taking that again one step further on Friday, we get that hybrid candlestick between that of a shooting star and also a gravestone doji. Forget about the real candle body. Don't worry whether it's white or dark. It's irrelevant. What you want to pay attention to is the failed upper wick. This is sellers. Why are people selling the S&P 500 or the Dow Jones Industrial Average around this 17,700 area? Let me just ask you the question. Is there any reason as to why people with a technical background who understand that the fundamentals are deteriorating would be selling this market up and around a potential declining bearish trend line? I mean, it makes perfect sense. If you go back out and project this back to May 2015, you can see again consecutive lower highs on the Dow Jones Industrial Average. You get the August waterfall sell-off, the somewhat short double bottom. You get the slope of hope rally back up into the declining bearish trend line. What happens? We stagnate. We go sideways. Ultimately, crack this level, come back down, and do the same pattern all over again. Ask yourself the question: does this pattern looks somewhat familiar to a pattern which has just established itself, possibly already eked out its high. I mean, it looks very much so, again, a mirror image of what we saw throughout September and through to the end of October 2015. Let me go through and show you this on the weekly chart again. The Dow Jones Industrial Average, again, this has been the outlier of the three widely followed US markets. The S&P and the NASDAQ haven't broken above the declining bearish trend line, but the Dow Jones eked its head above it last week or 2 weeks ago, if you want to count this week as its close. Now, it held above it all for about 1 day until we started to see this week, most recently, again, the sellers come back in and sell this market back down below the primary bearish trend line. Ask yourself the question, has the Dow Jones Industrial Average broken above the highs which we saw in November and December 2015? What is the answer to that question? Has the Dow Jones Industrial Average broken above this high? The answer to that question is no, it hasn't. Has it broken above, obviously, its 2015 high? The answer to that is no, okay? The slope of the market at the moment, at best, is sideways. The greatest bullish argument I can make for this market is that it is consolidating in a sideways pattern between support and resistance. If you really want to get technical, there is some validity to the argument that we are putting in some form of a descending triangle. If that is the case, with these lower highs, 60% of the time, statistically speaking, it breaks to the downside. So it doesn't matter which way you break down this argument, we are in a series of lower highs and lower lows on the financial markets. The Dow Jones Industrial Average, again, down 215 points this week, not the biggest move, but this is most likely going to result in additional structure somewhere around these current levels between 17.2 and 17.7 on the Dow Jones Industrial Average as to where structure is going to set up most likely, or as it did in November and December, until ultimately we resolve ourselves to the downside. Now, let me take this again one step further. When we're in a sideways moving market, the trend is, the market itself, there is no established trend in terms of a bullish trend, okay? It's broken. If I go back and show you this on the weekly chart, it's not rocket science. You can see over here in 2009, we've had 3 fan lines. We've got one through 2010. The second fan line adjusts through 2012. The third fan line extends through to 2013. If we project this out into the future, we touched it in mid to late 2014 over here. But since August 2015, we've broken below it. That is the primary, the third and final bullish primary fan line. We've come back up. We've retested this old trend line as new resistance. We've failed. And now again, we're eking out the establishment of the new primary bearish trend line. Let me show you what happens in terms of an overbought market. Have a look for yourself. What I've done, I brought up the stochastics indicator, the RSI, the relative strength indicator, and the MACD. Ask yourself the question, how is this jigsaw puzzle coming together? Now, again, I never try and be arrogant whatsoever. I'm a very humble person, but ask yourself the question, is this a buy signal? Anyone who knows the stochastics, is that a buy signal? The RSI, I mean, is that a slope to buy, or is that a slope saying, look, there's weakness on the horizon? When you get a MACD cross like this, is this a bullish MACD cross or is this a bearish MACD cross? I'm painting the picture for you. This is bearish on the daily chart. The RSI is giving us a sell signal. The MACD, which we've been waiting for to cross bearish since the establishment of these macro lower lows, has just given us a sell signal. All 3 of these indicators are in agreement. Not only that, but we've got these markets which are extremely overbought, coming back up into overbought territory, back into these declining primary trend lines, which are still broken, with the markets again establishing a consecutive lower macro, lower highs. And there's people out there who are saying everything is okay, keep buying this market. Well, if you want to be a hero and buy the market, I'd suggest you just start buying it as it is right now. But I'm telling you right now, I'm doing quite the contrary, and I'm securing a long-term net short position on these markets. Now, why don't we take this one step further again? I've shown you the overbought nature of this market on the weekly charts. On the daily charts, you can see that there is no reprieve really for bulls out there who are saying or trying to justify again jumping into this market so far. Why don't we have a look at this one step further and bring up the weekly chart? Now, the weekly chart is always late to the party. It always lags the actual price movements. But as we get these tweezer tops up at these resistance levels, ask yourself the question, what is the stochastics doing? It's getting very close to that overbought state. Now, during bull markets, the Stokes, the RSI, and the MACD will remain overbought for a prolonged period of time. It just happens. It's how these technical indicators are calculated. But in bear markets, very rarely do they move back up into overbought territory. Very rarely do we see bounces in bear markets with the slow line getting back above the signal line up here at 80. So we're in the vicinity where the weekly stochastics is going to adjust and it is going to turn down. The RSI, which is a faster calculation, it uses less time, it's 9 days, has already turned down. And the MACD on the weekly chart is largely irrelevant. If you go back in history and pay attention to the weekly on the MACD signal, its purpose or use, anyone can justify, it just becomes defunct. You can see during sell-offs, or during bullish bounces, you get late crosses, and during sell-offs, you're almost at the bottom by the time you get the sell signal. Much like, hey, we've got the buy signal most recently in the MACD, but we're more or less back up to the relative highs, which we're currently trading at. If we zoom on out, and I show you this on the monthly chart, I do this from time to time. If you pay attention to the major sell signals on here, and if I zoom out and bring out enough information on these charts, I can apply it to anyone. It doesn't matter. What happens when you get the MACD signal cross on the monthly chart? All right, you get corrections in financial markets. Much like when you get the MACD bullish cross on the monthly chart, you get bull markets. So we're establishing that all three markets are breaking the primary bullish trends. All right, they're now establishing lower highs and lower lows, macro lower highs and lower lows. The market itself has rallied. It has moved into an overbought nature. We're seeing early reversal candlesticks on the daily. We're seeing reversal candlesticks now set up on the weekly charts. You can see the MACD is obviously very bearish. The RSI is still very bearish. The stochastics has got a temporary relief sort of cross, but this is going to turn down very, very quickly. Where's the justification in buying this market right now? All right, what is the justification in buying this market? I've got more to speak about, but before I move into that, let me just address some of the issues taking place on the Russell 2000. Actually, before I get there, I've already skipped a couple of steps. It doesn't matter which part of the markets or which particular indice I apply this to, whether it's the Dow, the S&P, and the NASDAQ, but we have got short-term divergences setting up. So in addition, okay, to the candlestick setting up, in addition to the overbought nature of this market, in addition to the primary retest of the primary bearish trend, as the markets have pushed on up a little bit higher, most recently in the past 2 weeks, you can see that we've made a higher high in terms of price. Have a look at the divergence setting up on the stochastics and on the RSI. Major divergence, major issue for these financial markets. We've got that cross on the MACD as well. I haven't even addressed this on the weekly charts as well. Pardon me, on the monthly charts. Have a look at this. We've got some huge divergences taking place on the RSI, which we just haven't seen really in the history of technical charting. This low which we've established in 2009 up until the relevant highs so far. I mean, we've just seen the parabolic rise of this market from cheap money, from QE, and until that continues, until the Fed formally announces another round of quantitative easing, which I'm sure they're going to do at some point in response to probably, the cycle of this, which I'm talking about taking hold. We're not going to see this market break out to new all-time highs, and I still stand very firmly behind that. Now, again, you can apply that to any market which you want. It doesn't matter whether it's the NASDAQ, the Dow Jones, or the S&P 500. You can see as we make a short-term relative higher high, and I'm not talking about a macro higher high. I'm talking about, a weekly higher high. Look at the RSI here. Look at the stochastics on top of the MACD cross right here. If I take this further, and this is a really good representative of market breadth. So people talk about market breadth. They say the Dow only encompasses 30 companies. Well, why don't we take the Russell 2000? How about that? If we look at this at the market itself, before I even put on annotations on this chart, ask yourself the question. Here we are. This is the relative high in the Dow Jones Industrial Average, the S&P 500, and the NASDAQ in May 2015. Does this look like a bull market to you? Is this market producing higher highs and higher lows? Can you see anything which is bullish about this market? I'm simply asking you the question. Obviously, I can't gauge your response, but I'm trying to get you to come to this conclusion yourself. Is this market producing a higher high? Has it produced a higher low? And the answer to these questions is no. On top of that, we've seen the Russell bounce. People are once again getting excited about this bounce. Are we above the 200 simple moving average? No, we're not. We're just above the 100 simple moving average. We're just above the exponential moving averages. But what's most important is that we're coming back up. And let me just bring on the annotations for you once again. We're coming back up and we're interacting with this declining primary trend line right here. Can you see that for yourself? I'm a horrible drawer. I'll be the first to admit it. But can you see that primary bearish trend line? What's happening now in terms of price? Let's just go through and validate some of these candlesticks. What do we have? I mean, I can go back 3 weeks because that's where the divergences start to set up, and that's what I'll show you next. But let's just go through and address some of these candlesticks. As the market has moved into parabolic nature, we're starting to see one black crows. Okay, we're seeing candlesticks reflecting indecision. We're seeing evening star 3-day reversal candlesticks. We're seeing flaky moves which do not have any commitment and follow through. We're seeing consecutive spinning tops. One black crow candlesticks again. We're seeing somewhat hammer hybrid between hammers and hangman candlesticks. We're seeing again flaky moves with no follow through. We've got perfect doji, gravestone doji, somewhat shooting star. A hangman at resistance. We've got an engulfing candlestick pattern here. Another one black crow. Another bullish inside day with no follow through. We've got another one black crow followed by a shooting star candlestick on Friday. That's a very quick assessment of these candlesticks. It's showing up at resistance. And let's take this one step further again. Do we or do we not have divergence across price moving back up into the declining primary bearish trend line? And divergence across these indicators, or at least the indicator settings, stochastics, the RSI, and is the MACD bullish or bearish? Answer me the question. Is there divergence? The answer to the question is yes. Short-term divergence, yes. Long-term divergence, which is more important on the weekly charts, has been setting up for years. Literally years. Not only on the Russell, not only on the transportational average, which seemed to lead these other 3 US markets, but also on these other 3 US financial markets, which are holding up better than these two, which I'm currently about to go through or presently going through right now. With the MACD cross, the bearish divergence on the RSI and the stochastics. Let me show you also, the ADX and the CCI. When a market's trending bullish, you look for the commodity channel index to hold above 100 and to see the market, or at least the indice or the ETF, holding relative highs, if not breaking out to relative macro higher highs and higher lows. You're not seeing that flow through to the CCI. Does the ADX like this bullish move? Is the ADX trending up or is it trending down? The answer to that question is that it's trending down. It doesn't like the move. It's calling the bluff on the markets, or it's calling the bluff on the Russell 2000. If you want to go further into this, I'm happy to address it for you. Again, this is for your benefit, not mine, but I'm happy to share. Dow Jones Transportational Average. What has happened? We've seen the parabolic move. We've seen the breakdown, first of all, below macro support. Let me take the annotations off the screen and ask you the very simple question. Okay, it's not a trick question. Does this chart look bullish or does this chart look bearish? Which direction is it moving? Is it making a series of higher highs or is it making a series of lower highs? Is it making a series of lower lows or is it making a series of higher lows? And again, I'm being humble in these questions, but I want you to answer them and come to this conclusion yourself. The answer to the question is, unfortunately, reality, fact, is that it's making lower highs and lower lows. And what makes this even more scary right now as I bring you this market update is that we've come back up into the declining primary bearish trend line. Everyone's very excited about the transportational average because it's moved from 6.5 all the way up to 7.7 as at the close on Friday. But what they're failing to understand is that this market is still registering those lower highs and lower lows. If we zoom back on into the detail, have a look at this. If I bring up the oscillators here, what's the MACD signal? Is it bullish or bearish? Very simple question. The RSI is getting a temporary relief bounce. That's fine. The stochastics is still bearish, but it's still weak. It is very, very weak. On top of that, we've registered 2 consecutive lower highs. So if I go back into the candlesticks, look at this. We've got the evening star reversal candlestick right at the declining primary bearish trend line. We've got shooting stars. We've got hammer candlesticks or hangman candlesticks at resistance. We've got gravestone dojis. We have dragonfly dojis too. We have these flaky bullish days, single days, which just keep getting rejected. We have hangmans at resistance, one black crows, spinning tops, dragonfly dojis, and again on Friday, we have another shooting star candlestick at resistance. We're building the structure. There's this pattern, okay, that we're setting up now. It's a little bit of a stretch, but would it be fair to assume that potentially we're in the early stages, even if we see a relief rally on these equity markets and we see the Dow Jones, the S&P push on up to, slightly higher highs? Doesn't it make sense that we're once again making the structure or forming the structure upon which ultimately these equity markets are going to take the natural course, the easiest course, which is to the downside? And, have a fair talk with yourself, but you should be coming to a pretty basic conclusion right now on these markets. Are we technically finding resistance at the declining 200 simple moving average? The answer to that question is yes, we are as well on the Dow Jones transportational average. Now, I've covered the Dow, the S&P, the transportational, and the Russell. There's obviously more I want to speak about for all of these markets too, but this is really the card up the market sleeve, so to speak, or the card which the bulls are holding. And this is just to put this in perspective, right? I mean, this is what you're looking at from these markets, where they're currently trading at, as to a logical area of resistance as to where it will be the final exhaustion for this move or this market moving higher. The NASDAQ, again, much like, with every market I've referenced, eked out not in May 2015, it actually eked out later in July 2015. We have this really nice island reversal candlestick pattern. Since then, we've got the macro lower low, got the macro lower high, and you can see for yourself the structure's built, we fall to the downside. We've also established another macro lower low. Doesn't it make sense that this is going to form, unfortunately, another lower high? Okay, that's what I'm concerned about. If you're still trying to piece this together, I'm concerned that people are buying this market and they're about to be screwed. Now, if I put the annotations back on the chart and I show you the declining primary bearish trend line, what's more important than that? You can see for yourself that we are still a long way away from even the potential of a back test on the NASDAQ. Same on the S&P 500. Technically, it's coming in just above 2,080. I've got projections up to 2,100. But if we go back to the NASDAQ, you see this red rectangular box on my screen. This is resistance. And generally, gaps fill. Much like the gap over here. When we were trading bullish on the NASDAQ, we had this big opening gap right here. What happened? Ultimately, the gap filled. The market came back down. It filled the gap and it bounced. Well, since the beginning of 2016, this has been acting like a magnet, for the market. Everyone can see there's an open gap. All right? Everyone can see that. And there's a very good chance that we still fill it. However, when we look at the daily candlesticks of the NASDAQ, if there was the potential to fill this gap, I'm very surprised it didn't happen on Thursday. Why is that? Because this is a continuation pattern right here. And as I've been talking about, as the market pushes back up into these resistance levels, and we see these candlesticks right here, but with no follow through, we're talking about long day Morobozu engulfing candlestick patterns with very minor lower wicks, if not any wicks, especially on Wednesday's candlestick, but there's no follow through to the upside. It's getting negated very quickly, as you can see, even on the NASDAQ on Thursday and Friday. I am still personally under the assumption, I'll put it out there, that the NASDAQ is going to fill this gap at the beginning of 2016. So for the bulls out there, congratulations. Here we are at 4,850 on the NASDAQ. You're looking at the NASDAQ eking out about 5,000. Isn't that number interesting? 5,000, a psychological round number. It's really building very, very nicely in terms of the jigsaw piece or the jigsaw puzzle coming together. Can you imagine the media reports? NASDAQ reclaims 5,000, not to mention or really not mentioning whatsoever that, hey, we're still negative year to date. Let me just bring up the yearly year-to-date movement in the NASDAQ. We're down 156 points. Let me take the annotations off the screen and very quickly show you this before one or a few more pieces which I want to quickly speak about. We have got, again, a Dragonfly Doji setting up on the NASDAQ on the yearly candle. If this moves dark, if we move back down to the lows of this candle, we're going to have an evening star reversal, not on the daily chart, not on the weekly chart, not on the monthly chart, but on the yearly chart. If we have a look at the S&P 500, have a look at these candlesticks. 2015, a doji. Again, we have another doji, almost another Dragonfly Doji. These are reversal signals. If we move down lower, if we get a sell-off of even 50 points on the S&P 500, this is going to start turning dark, and it's going to become very evident to people who can see this. This is going to be another evening star reversal on the yearly candle. Have a look at the NASDAQ. NASDAQ has been the strongest, relatively speaking, of the three markets. The same pattern is starting to show up. If not, we have a high wave spinning top for 2015. So it was the market of the three, which did close positive year to date. Now, this is where, I don't know, I can keep speaking about financial markets. I don't know if people are interested in this analysis or what it is I have to say. I assume there are people out there who do value my opinion on the financial markets, given the technical snapshot which I bring to people. But let me just show you this final piece of analysis. I can keep bringing you information, but let me just show you this. Maybe a month ago, I'm not exactly sure when I updated this video, right, on YouTube. I'm just trying to, actually, I don't need my annotations. I'm sorry, I'm just speaking to myself as I do this. On the monthly chart, I want to change to the 10 and the 20 simple moving average, and this is a really important sell signal. So everything I've spoken about, that's very important, right? But this, in terms of reliability, it hasn't produced a false signal. It doesn't matter which market we apply it to. It doesn't matter. I'm going to leave the NASDAQ till last because there's a big point I want to address in this. But let me just start with the Dow Jones, because the Dow Jones had the ugliest period at the turn of the millennium from 2000 into the year 2002. The S&P loved this signal. The Dow Jones did respect this signal, but you can just see how ugly all this chop fest was back and forth. Pay attention to the monthly chart, the 10 and the 20. What happens when the 10 crosses below the 20? And price moves below both? What happens when we move into bear markets? It's unfortunate, but it's reality. It's fact, right? You get the bear market, 2000, which more or less ended in the year 2002. We eked out, again, a relative low in 2003. Then what happened? The 10 crossed above the 20. Price crossed above both. We move into a bull market. What happens? The bull market continues into 2007, 2008. Unfortunately, price breaks below the 10 and the 20. The 10 crosses below the 20. Then what happens? We move into a correctional type of move. We get the cross again the beginning of 2007. We get the bull market all the way back up to 2015. What has just happened? Now, this is where I'm going with this most recent talk. I put out a video when we got this cross. So I assume the video I updated would have been in January sometime. Maybe it would have been February. But somewhere over here, I put out the update saying, look, be careful. This signal, this macro sell signal has just occurred and it's still in effect. What is interesting to note was that last month, so for the month of March, I was expecting to see more selling pressure and to establish that upper wick, right? Because what happens is you see these moves fail and it will either establish an upper wick if it's towards the end of a month, right? So you get an upper wick, or it will just result in a dark candlestick. So if you see the Dow Jones Industrial Average close below 17,409, we are back below the 20. If you see it close below 17,155, we are now below the 10. We are below the 20, and the 10 is below the 20. So it is in perfect agreement as to the technical signal, which established itself in 2016. If I change to the S&P 500, I'm going somewhere with this, so just be patient. A very similar type of signal, right? That's a horrible circle. We got the crossover here in February, so that's the one. I must have updated it when the S&P 500 made the cross. That makes a lot more sense to me as I go through and recap this video. We've seen the 1 month, the long day Morobozu candlestick, and we've got a doji or somewhat of a spinning top right now as at the close on Friday. It's only a week into the trading month of April, but we're starting to see the formation. If this fails on the S&P 500, pay attention to 2035, 2017. If this turns dark and price moves below the 10 and it also moves below the 20, the 10 below the 20, then that is a very bearish signal. That means two of these two markets once again are in territory which we've only seen during correctional phases of markets. Now, this is where it gets a little bit scary because we've got two of the three markets which have got the bearish cross, but the NASDAQ hasn't, or it doesn't as at the current juncture. Look at this signal right now. Okay, I'm going to zoom in on this signal for you. All right. And again, this is going into warning signals. These are warnings. These are major warnings. That was meant to be a W, by the way. If you can't recognize the importance, the significance of these signals right now, and you're just flying in the dark saying, hey, everything's okay, then nothing short of foolishness there and recklessness, really. If you don't agree with me, that's fine. But again, I'm the messenger here. I'm sharing this information with you. All right. But if you have a look at the NASDAQ right now, I mean, I might zoom out just so I can recap some of these candles for you. The NASDAQ is the last of the three markets which has formally given us this very bearish signal, right? Signals which are only generated since the turn of the millennium over the past 16 years, which have only been generated when they are true signals, right? Every signal, bearish or bullish, has resulted in a bull market and a bear market. Not only has it happened once in the dot-com bubble, it's also predicted the 2007-2008 top, and here we are again in the year 2016, and it's about to cross. Look at this most recent candlestick. This is on the monthly chart. Obviously, it's 1 week's worth of data. It appears to be a shooting star. Can you see that? A shooting star at the critical pivot point, at the current juncture, right now, literally right now. If I zoom in close enough, the pink line is the 10 simple moving average. The blue line is the 20 simple moving average. The 10 is just above the 20. I'm going in almost to this one candlestick. Look at that. You've got the long day bullish bounce. Everyone's really excited. Yeah, everything's fine. Then you get the shooting star. If we get any follow through in the NASDAQ, there's a very good chance that this print, right, as at the close of April, at the end of April 2016, is going to result in the 10 crossing the 20 with price below both, with all three markets in agreement. Now that's a really big deal. At the moment, you can see the 10 simple moving average is coming in at 4,858. The 20 simple moving average is coming in at 4,836. So you can say that roughly, look, 22-point difference between the 10 and the 20 simple moving average on the monthly chart on the NASDAQ, with a very bearish candlestick to begin the month of April. All right, so these are some of the points which I think is beneficial to anyone who wants to, have a clear understanding of trend direction and not get swept up in this 1 to 2 month bullish bounce, which is, again, not a surprise to me whatsoever. Go back on my YouTube channel. I'll give you the date right now. And go back and look at this catalog. And this is not to bloat whatsoever, but signals are very predictable, right? And the resulting market movements are very predictable. Somewhere on this date here, I assume, it would either be February 11th or February 12th, one of those dates. Go back. I'm not going through this right now in this recording. Go through, and the title of the video I made was Bears Beware, right? Bears Beware. The sentiment of this market at these lows, I mean, people have short memories, don't they? It was excessively bearish. It was as if this market was on the verge of tanking. Right? No matter what media outlet, financial media outlet you turned on, it was, bad things were happening, right? But if you keep a level head and you don't succumb to market noise and you don't buy into the complacency of what the bears were down here and what the bulls are doing right now, and you respect long-term momentum, then you can fly clear in the face of very risky trades, which people may be placing up here in terms of bullish trades, in the face of, again, educated, informed traders, not only traders, but also money managers, institutional money managers, who are not only lowering their long exposure, but trying to secure long-term short exposure for this market. All right, that's what's going on at these levels. It's called distribution for a reason. The informed investors are distributing, unfortunately, to gullible people or to people who are buying into, again, the complacency of this market. And, very simply, we're not in this, or we're not technical traders managing billions of dollars. That's a fact, right? So we can enter and exit the market very easily and very quickly. And this is the big if the market breaks the 2015 highs, we'll have to reassess our long-term outlook on the market, right? I think that's fair to assume. Always calculate your risk tolerance. Understand the risk that you are taking, ownership of prior to a trade, before you put that trade on. But in my opinion, to conclude in this technical snapshot, now I don't know when I'll produce the next technical snapshot, pardon me, for a market update on YouTube. I do it each and every weekend in that pro analysis class. But to leave you with something, or at least something to think about over the weekend, in my humble opinion, take it or leave it, it doesn't bother me whatsoever. I assume with high conviction that this is the opportunity, potentially the final opportunity, where the market will be trading at these historically overpriced levels, 26 times earnings. The mean is somewhere between 13 to 15 times earnings. We're trading at 26 or just below that, 25 point something now with this slight pullback in the market. The third most overvalued market, or joint third since 1880, outside of the Roaring 20s and the 29 crash, and outside of the dot-com bubble where you had tech stocks trading at 40 times earnings. Right now, this market is just joint, more or less tied with the 2007-2008 top in terms of its overvalued nature, or the overvalued nature of the market itself. And on top of that, it's also the third longest bull market since the 1800s as well. So you've got the joint third most overvalued market with the third longest bull trend or bull market. People are still calling this a bull market, which is somewhat confusing to me, because clearly the trend has changed, and it's not going to be until a couple of months. I mean, just think about this, all right? I'm saying maybe it's a good idea to hedge, all right? If you just think about this for a moment, and this is what I'm going to end on. If you take the high of the Dow Jones Industrial Average at 18,000, and you take 20% of that, okay, I think roughly it comes in around 4,000 points. I think I read that in an article, and that just struck me more or less to the core. 20% of the market high is about 4,000 points. Why 20%? Because that is the official start of a correction in financial markets. Do you want to wait 4,000 points for a drop just to be told that, hey, the market's declined 20%, we're entering into a bear market? Do you need to be that foolish and wait for a 20% write-off in your portfolio until you take a hedge, or until you start, unfortunately, succumbing to fear and panic of people selling in the market? Does that make sense to you? Here we are at 17.5. The high was at 18,200. It's as if you don't have insurance on your house is burning down, and then again, someone comes along and offers you, again, fire insurance. Now, that's a line out of, again, The Big Short. So if anyone's seen that film, you know what I'm talking about. But really, what I'm trying to say is that this may be the best price which you have, again, to take on a hedge on these markets if these signals take place. All right. So just think about that analogy. It's just a funny way, somewhat humorous way of sort of presenting the unfortunate truth, or the unfortunate reality of where these markets are holding up. Now, the Dow, the S&P, and the NASDAQ are holding up much better than the transportational average and the Russell. However, the Russell and the Dow Jones transportational average have been leading markets. Okay, they've been leading these other three US markets. So you go back to the Russell and you look at this. We eked out the higher high, or the all-time high at the same time, roughly May 2015. But since then, it's been down, 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 down. If you go to the Dow Jones transportational average, this is a little bit earlier. Have a look at this. This eked out towards 2014. So since then, it's just been lower highs and lower lows. So, I mean, these haven't changed. The trends haven't changed. And the fundamental picture since the trend changes haven't gotten any rosier. Right, they've deteriorated further. Now, there's a huge disconnect again between financial markets, or the prices of assets on financial markets, and the disconnect between where we are economically around the world. All right, there's a huge disconnect right now. A lot of malinvestment. The truth is that malinvestment adjusts, it corrects, and what that means is that asset prices, will reflect their true fair market value eventually. Now, again, there's only so much time that this can be extended and pretended, but it's really looking as though that's on borrowed time right now. So I think I've Probably overshot my mark with you in terms of time. My apologies if this went on for a little bit too long, but these things I'm a little bit passionate about, and it's always good to share this information with people who want to listen. So if you found that beneficial, share it with someone, give it a like. If not, tell me how much you hate the analysis and how wrong I am. I haven't looked at any YouTube comments in maybe 2 weeks. I find them humorous, but good on you. I appreciate the support, by the way. Don't get me wrong. I love the support. I'll check it now when I upload this to YouTube, because this is the first video since the last video that I've seen. But I'm sure I'm going to have a little bit of a laugh in a couple of minutes when I go through and just see, some of the things which have been said. I can only imagine. But look, thanks a lot for the positive vibes, for the thumbs up with the analysis. I appreciate it. It lets me know that you that it's worth it, really, for me to invest my time into sort of just speak through my thoughts with the financial markets, or on the financial markets with you. Outside of that, everyone, have a fantastic weekend. Think about the opportunity to hedge. I'll write it on my screen one more time, and this is the way I'm going to finish the video. The opportunity to hedge. Don't have to hedge everything, but maybe a portion. Or just think about it, or maybe even make a plan of action to say, look, if the market drops further, what am I going to do? How am I going to prepare? So outside of that, everyone, have a fantastic weekend. I will be back with you at some point. I'm not going to guarantee it will be this week. I'm not going to guarantee it'll be in 2 weeks. I'll update you again when the time is right and when it's necessary. And I really just want this to sort of resonate with people. A lot of people, again, get caught up in the day-to-day market fluctuations and the noise. Dow rallied 100 points today, everything's good. Or the Dow sold off 300 points today, everything's bad. But the technical picture is what matters, right? And it's very, very simple to see. You just need to leave your emotions at the door, become a little bit more analytical. Okay, so on that note, everyone, it's James signing off on behalf of Pivot Point Trading. Be careful out there. Goodbye.